Hi, I'm Chris Mankoff, certified financial planner and partner at JTL Wealth Partners. In this video, I'm going to dive into what is a Roth conversion and why it could help you keep more of your money in retirement. I'll explain when a Roth conversion makes sense, how to manage the tax impact, and maximize your tax-free growth, whether you're 10 years away from retirement or if you are already collecting those RMDs. So we're going to go over how does a Roth conversion work. It's really simple. You're basically just moving your money from your traditional IRA into your Roth IRA. And so you will be paying taxes on the conversions in the year in which you actually make those. So you can kind of see here, we're just taking our dollars from our IRA and just moving them into our Roth IRA. But here's a catch, right? So you need to be smart about how you convert and how much you convert, because converting too much could really bump you up into the next tax bracket. And so that's where the planning comes in. So here's why you want to do a Roth conversion, right? So the first one is to take advantage of any tax bracket arbitrage. Simply, if you're in a lower tax bracket, early retirement, gap years before RMD, or Social Security. So, example, you're 62, retired, and living off cash savings. Your taxable income is only $40,000. So, converting $50,000 from your IRA to a Roth now locks in a 12 or 22% tax rate instead of waiting until RMDs push you into a higher tax bracket. Another reason is, I just mentioned before, is reduce future RMDs. So Roth IRAs don't have required minimum distributions, which is huge when you get into retirement. And so, for an example, you have an IRA that's $1 million and just hate the idea of being forced to take large withdrawals and pay tax at age 73 or 75. Roth conversions in your 60s can reduce your pre-IRA tax balance, and which shrinks future RMDs and tax bills. The good thing too is, right, you have tax-free growth and withdrawals in the IRA. So your Roth account grows tax-free and withdrawals are also tax-free. So for example, you convert $100,000 today, and if that grows to $300,000 over 20 years, you made $200,000 worth of tax-free growth. And if you wanted to pull that $300,000 out all at once, you don't pay any taxes on that, which is awesome. The other thing to consider too is surviving spouse protection. So when a spouse passes away, it bumps the surviving spouse in a higher tax bracket. So think of when you file your taxes, you're filing joint versus with surviving spouse, they're going to be filing single. And so while both spouses are alive, you're already in the 22% tax bracket. But let's say if one passes away, the survivor could jump to the 32% tax bracket. So converting while married helps lock in those lower tax rates while you still can. And not to mention when your surviving spouse is taking money out of the IRAs, if it's coming from a Roth, that will be tax free. And another thing to consider too is legacy planning for your heirs. And so, the beneficiaries can take tax free distributions from an inherited Roth within the 10-year period. And so, example with that is, you can take it over a spread 10 years, or if you want to wait till the last year to do it, you can do that. It's really up to you. So, you get to dictate how you want to take those distributions. So, an example here is, you leave your kids with tax free money. Roth conversion today essentially saves them for getting taxed on a large IRA, possibly during their peak earnings, years. Another reason you want to do it too, and you can ask 10 people and you'll get the same answer out of all 10. Our rate's going to, taxes is going to be higher in the future, and so this is a good way to take advantage of today's tax brackets, and because some of them are set to sunset after 2025. Whether that sticks, who knows? But in this example, let's say, 2026, the 22% tax bracket could go back to 25, 24 can go to 28. So locking in today's rate via conversions may be a smart hedge. So we're going to highlight some benefits and considerations, which I previously touched on a little bit in the previous slide. So the first thing, one of the benefits to consider is if you're doing these conversions and let's say it is a down year, we've got a pullback, correction, or, heaven forbid, we have a bear market, that could be a good time to start doing some conversions, especially if it makes sense from a tax perspective, because when you're converting these IRA dollars at a depressed value and you're paying a tax on those, dollars there. Let's say you take that same amount, you put it in your Roth and the market rebounds, or even better, over the next 10, 15 years, depending on your returns, it doubles. And so that's really a good time to take advantage of those market conditions. And so, yeah, I mentioned earlier, hedge against rising taxes. I don't know anybody out there that believes tax rates are going to drop. So again, this would be another thing to consider. The other thing that I see a lot with, especially as a planner, you look at asset location, which means having dollars in a pre-tax account or a tax-free Roth account. So it gives you flexibility to manage your income in retirement. And as I mentioned earlier, there are no RMDs, and so that's a lot of people didn't plan for these huge RMDs when they're putting money into their IRAs or even their 401ks. And so this is a good way to really mitigate or even remove the impact of RMDs. And so tax loss harvesting too. So harvesting losses in your taxable account can offset part or some of the conversion tax, efficiently discounting the cost of moving money into a Roth. Now, that doesn't mean that that's going to be dollar for dollar, but it is something to possibly consider when you're doing that. Now, that's not going to be a huge differentiator in that, but every little dollar counts. And of course, like I mentioned before, the estate planning benefits. So when heirs inherit Roth assets, they're without RMDs, and it's a great way to transfer your wealth if you choose to do so to your heirs in a tax-free manner. Some things you want to consider, right, is your time horizon. So the longer the money remains in the Roth, the more time it has to grow tax-free. So conversion is really going to make the most sense if you have several years or decades away from tapping those funds. Now, this necessarily wouldn't make sense. Let's say that you're already in your 70s, you're taking your RMDs, and you start looking at this, because this certainly may not make sense in that certain situation. As mentioned before too, you want to take into consideration your current tax bracket. So anytime you do any conversions on the Roth, the IRA accounts, you're going to owe ordinary income tax on that converted amount. And so, like I mentioned before, converting in a year when your bracket's usually low or unusually low due to a career break, sabbatical, or temporary income dip, that really is going to help minimize your upfront tax costs. And of course, this is a good strategy to consider in retirement, like I mentioned before. So you want to be able to just kind of get an idea of what your future tax bracket's going to be in retirement. And so if you expect to be in the same or higher tax bracket, converting at today's rate, could save you money over the long run. But if you are going to retire in a much lower tax bracket, you might prefer to defer conversions. That's something that you really want to look at from a planning perspective. And that's really where we will be able to sit down and take a look at your situation and just see if it makes sense. And so the last thing on here is to consider the tax conversion liability. So ideally what you want to do is when you do these conversions, you don't want to pay the taxes out of the conversion. You want to pay the taxes from money outside the IRA. So the reason why you don't want to do that is if you're using those assets to pay the conversions, then that's going to decrease the amount that you're actually investing, and you're going to lose the growth on that. And so, and you also might trigger penalties if you're under 59 and a half. So that's definitely something you want to stop and consider before you're doing this. So what we're going to look at real quick is what is a contribution versus a conversion. So really with the contributions, it's real, basic. It's just like if you're going to make a contribution to an IRA or a Roth IRA, the first thing is you have to have enough earned income to make those contributions. And the other thing too is you want to look at what the income limits are. So depending on how you file, joint, there is a phase out. Single, there's a phase out. Or if you're married, filing separate, there's also a phase out in terms of how much income you can make before you can actually make the contributions. Now, in this case, for an IRA, that would be in terms of being able to get the benefit of the contribution this year, versus with the Roth, you obviously don't get the benefit when you're, the tax benefit of making the contribution this year, but it also still has those contribution limits. The other thing too you want to keep in mind with the Roth conversion rules, and like I mentioned before, is the year that you do the conversion, that is going to be taxable ordinary income. So you want to make sure that you are keeping that in mind. The other thing too is you've probably heard of the qualified distribution rules with the Roth IRAs, right? So there's a 5-year clock that starts with that. So the great thing is the 5-year clock starts January 1st of the year you made the contribution. So for example, let's say you made the contribution on December 31st, right? Well, and then you turn around and make a contribution on January 1st, right? Now you actually have 2 years worth of that Roth IRA. So that is something to keep in mind too when you're doing any distributions from the Roth IRA. So it has to be at least 5 years being held in that, and 59 and a half, or if it's obviously if it's there's a death then or a disability, then that would be considered a qualifying event. In this slide here, we're just going to go over some of the tactical Roth conversion approaches that I mentioned previously. So we're going to take a look at when you have the flexibility to manage your taxable income, or you can generate some deductions. You can actually time Roth conversions to minimize the tax hit and maximize your after-tax benefits. So again, here's a couple of approaches that I mentioned before, but just want to highlight those again. So if you have a low income year, then it's really a good time to take a look at doing a conversion if it makes sense for you. If you are maxing out your retirement plans, or before you convert, you might want to look at cranking up your 401k, 403b, or SEP IRA contributions. So those pre-tax deferrals can reduce your adjusted gross income, which in turn lowers the marginal rate on the conversion. So you definitely want to keep that in mind. Another thing to think about too is itemized deductions. Now, with the standard deduction this year, a lot of people don't use itemized deductions in there, but if you are charitably inclined, you could look at doing a donor advised fund, where you could get today's deduction and then spread the grants over the future years while your Roth balance grows tax free. I mentioned earlier offset with capital loss harvesting. This isn't really necessarily a magic pill for this, because you're only allowed to offset your income with capital losses up to $3,000. So even a little bit can knock off a notch of your effective conversion rate. So for the business owners out there, you can time your business expenses. So you can prepay or accelerate deductible business expenses into the conversion year to shrink the adjusted gross income. And if you control consulting income, rental distributions, and royalty payments, you could possibly defer them to the next year or accelerate them back to last year, so your current year income bracket stays as low as possible. If you're an executive that has non-qualified deferred compensation plans, many of those plans let you elect when your deferred salary or bonuses are paid out and taxed. So you can coordinate those election deferrals to push income into a lower tax year, and then use the extra bracket space to convert a larger chunk at a favorable rate. And again, this is leveraging the bracket bridge. So map out where your marginal rate bands are and start looking at converting those up to those bands. This is an exercise that I do with all my clients to really see where we can go in terms of maximizing that bracket bridge there, because you would be shocked to see how much in taxes you will save by using this type of strategy. So that's something we map out and look at, and it's really an eye opener. So the bottom line here is deliberately sculpting your income and deductions. You can carve out a tax mode around your Roth conversion, paying the lowest possible rate today, and then locking it in for decades worth of tax-free growth. So in this slide, we're going to talk about why you want to be careful if you are considering paying the conversion tax from the withholding on the amount you're converting. So really, to put it bluntly, you're effectively robbing your Roth of its growth potential. And so you want to make sure that you, if at all possible, you're not doing that. And so the reason why that matters is if you're under age 59 and a half, the IRS is going to consider that amount obviously as a distribution, but it could also trigger a 10% penalty on top of the ordinary income tax. So you want to make sure that you pay those taxes with funds held outside of that IRA. The other thing too is every dollar that you're withholding to cover that tax never makes it into the Roth. So that's going to reduce the base that can compound tax-free over decades, right? So, put that in perspective. If you convert 50,000 and withhold 10,000 for taxes, only 40,000 is making it into that Roth IRA. And so that extra $10,000 over time, plus its compounding growth, can be a significant opportunity cost. And the other thing too is you might experience uneven withholding rates. So if you're just withholding at a flat rate of 10%, then you may actually underpay or even overpay your true tax liability. So that could also lead to surprises when you're going through and filing at tax time. And so, of course, if you're paying it out of dollars outside of the IRA, then the amount that you're converting is the amount that you're going to be putting into the Roth IRA. So every dollar is actually going to make it into your Roth IRA. Like I mentioned previously, the tax liability of it. So by doing this, you can calculate and figure out exactly what you owe, rather than relying on a flat withholding rate that may under or over withhold for you. And of course, preserve liquidity inside the IRA. So keeping that money instead of withholding it from the IRA is going to keep your balance intact. So that's going to obviously give you that compounding growth opportunity later on down the line. And so, of course, with the Roth IRA, paying those taxes outside of the conversion amount, obviously a larger Roth IRA is going to tax to your heirs tax-free without RMDs, and it's going to increase the assets that's left to them. So bottom line here is covering the tax bill from outside funds preserves your full conversion amount, and it's all future tax-free growth within the Roth account. So in this last slide here, I'm just going to talk about stealth taxes on the Roth IRA conversion. So you want to be mindful that a big conversion can actually trigger a stealth tax, right? So that's going to be any tax that goes beyond the conversion bill itself, which could ultimately force you into quarterly payments. So you definitely want to plan accordingly to make sure you can avoid having these stealth taxes on your conversion. So a couple things to consider, right, is your Medicare IRMA surcharges. So if you're, on Medicare, a spike in your adjusted gross income could push your Part B and D premiums up higher. So you want to definitely keep that in consideration. Another thing to consider is the net investment income tax. So if you do a conversion that will basically put you in or raise your adjusted gross income to the higher tax bracket, then that could subject you to a 3.8% income tax on your investments. Another thing to think about as well is Social Security taxation. So depending on your income levels, that's going to really dictate what part of your Social Security is going to be taxable. You can also lose certain credits or phase outs, where if you're taking certain deductions right now or you have certain credits you can take advantage of, a big conversion could really possibly eliminate those credits and deductions. Another thing to consider too is if you live in a state that has state tax, a conversion on here could trigger or increase your state taxes. So you want to keep that in mind as well. And of course, if you are in a higher tax bracket, it could also subject you to AMT. So you really want to be careful of that. And so with the quarterly estimated tax payments, like I mentioned before, that's not something to be scared of. So I don't want the quarterly estimated tax payments to really dissuade you from looking at this strategy. But again, you want to stay on top of that. So you want to make sure that your withholding covers the extra taxes for the conversion. And so that can also, be determined on when you do these conversions. So depending on when you do the conversions, if you're not making those quarterly estimated tax payments, then you obviously could be subject to an underpayment penalty through the IRS. So there are a few things that you can do to avoid those penalties. So you can either prepay your taxes. So if you have an idea of what your taxes are going to be this year, you can pay either 90% of this year's tax liability or 100% of last year's tax liability. Now, if you're in income bracket of over $150,000, then you're going to want to pay 110% of last year's tax liability. So that's going to wrap up this particular presentation on Roth conversions. So I will be adding another one here talking about some other Roth conversion ideas and strategies to really piggyback off of what we went over today. So feel free to click and like, subscribe to the channel here, and stay informed.